In this video, we're going to talk about the 2021 contribution limits for the 401k, 403b, 457 plans, IRAs, and traditional IRAs. But before we get into it, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. So up here on the board behind me, we have the contribution limits for 2021. Now, the contribution limits are the same for 2021 as they were for 2020, but there are some things that you want to be aware of while you're making these contributions or figuring out how much you should actually contribute into your retirement plan, whether it's at work or in your IRA, whether it be a traditional or a Roth IRA. So let's go ahead and get into it. So up here on the board, we have our 2021 contributions for the 401k, the 403b, most 457 plans, and the Federal TSP or the Thrift Savings Plan. Now, this hasn't changed from 2020 to 2021, so that's why I wrote it like that. But here it is $19,500. Now, that does not matter whether or not it's a traditional or a Roth contribution. Those get combined. So however you want to split it up, and whether or not you have one job or 12 jobs, it doesn't matter. The entire amount across all of those retirement plans, from the 401ks to the 403bs, they can only be a maximum of $19,500, but that is your contribution, also known as the employee contribution. There is an employer contribution, and we're going to talk about that in a minute. Now, for the catch-up contributions, this is if you're 50 or older. So 50 or older, you can do an additional $6,500, bringing the total to $26,000. So if you're 50 or older, you can make a total contribution of up to $26,000 in these retirement plans. Now, for the IRA and the Roth IRA, those are going to vary a little bit differently or work a little bit differently than these retirement plans. Now, all of these, the traditional and the Roth, are going to have income limits, but all of them have contribution limits. So it doesn't matter how much you earn with these plans, but it does matter with these plans. But we're not going to go for the income limits in this video. We're just going to talk about the contribution limits, how much you can qualify potentially. So with the traditional and the Roth, it works similarly with the 401ks, where they are combined. So that combination is $6,000 for a normal contribution, or with the catch-up, similar to their other retirement, the workplace retirement plans, you can do an additional $1,000, bringing it to a total of $7,000 if you're 50 or older. So that's for both the traditional IRA and the Roth IRA. Now, whether or not you can contribute into this plan also matters how much you're earning and whether or not you also have a retirement plan at work. So check out some of my other videos on those income limits. But the contribution limits, traditional and Roth, are combined at $6,000. If you're 50 or older, it's an additional $1,000. Now, there's a couple of other things that I want to talk about with the contribution limits for 2021, and this worked for years past too. So if you're looking at your 2020s or you're redoing your 2020 taxes and want to figure out those contributions, then the same numbers would still apply. So starting with the match. The match is your employer match to your contribution. So typically it's like 3 or 4%. So if you're putting in whatever percentage you're putting in, the most, as far as a dollar amount goes, is either 100% or $19,500. Now, that doesn't limit the amount that your employer can put in. They can do a match, and those limits are significantly higher. For 2021, it's $58,000. So you're not going to run into a contribution issue when it comes to you putting in the money and then your employer matching you, okay? So that is what the match is for. So it doesn't mean that you have to worry about that. So if you're figuring out how much you should put in, do the math based on these contribution limits only. Don't worry about what your employer is necessarily putting in. So the second thing I want to talk about are the types of contributions. Now, you can put in a traditional a non-deductible, or a Roth contribution. So those are the different types of contributions that you can make. Traditional is pre-tax. So this is lowering your adjusted gross income, which is very important, and we're gonna come back to this. That's your traditional contribution. Your Roth contribution is your after-tax contribution. So it's not going to affect your adjusted gross income in the year of your contribution into the Roth or the Roth side. Whether it's a Roth IRA or whether it's a Roth 401k, that does not matter. What matters is that it's after tax. It goes into the account, grows tax deferred, tax free. When you pull it out in retirement, it is tax free. So that is the beauty of the Roth IRA, but it doesn't reduce your adjusted gross income. I can't stress that enough. It's very important that you're paying attention to that. Now with a non-deductible, it's a little bit different type of a contribution. It goes in after tax like the Roth IRA, but it grows tax deferred, kind of like both accounts. But when it comes out in retirement, then it is taxable. So it's a little bit of a type of like a hybrid type of a contribution. Why would you make one of those? Because of income limits, which we're not going to talk about in this video. Now, when it comes to these other retirement plans like the 457 plan, it stands alone. So you want to look at your 457 if you have one, because those contribution limits would be separated from the 401k and the 403bs. So that means you can put in, if you have two employers, you can put in a lot more into your retirement plans. But if you have, say, two 401ks, two different employers, has a 401k, the total amount is still $19,500 across both of them. So it's combined. So you have to pay attention to that. The next thing I want to talk about is earned income. Now, this earned income really is only affected by the IRAs. It has to be earned income. So in a year, let's say that you are either retired or you're not working and you don't have any earned income, then you cannot make a contribution into your traditional or your Roth IRAs because you need to have earned income. So it's really important. Now, if you had earned income earlier this year, and let's say you're on unemployment, don't have a job, you're in transition, not earning anything right now, you can still make that contribution. You just need to make sure that you have earned income in the year, the taxable year that you're making the contribution for. Now, the next thing I want to talk about is credits. Now, credits are super important, and that's what I was talking about when you're trying to figure out whether or not you should put money into your traditional side or your Roth side. Now, the Roth IRA or the Roth 401k, Roth 403bs, whatever, your Roth side goes in after tax. So a lot of people look at it and saying, well, my growth is never going to be taxed. Yes, that is true as long as you take it out in retirement or for certain situations. But you also want to pay attention to your adjusted gross income. So that is what most of your credits are based on. So for example, you have the saver's credit, meaning if you just make a contribution at certain income levels, you'll get a tax credit. And that is a dollar for dollar reduction in your tax liability. So it's a huge benefit. And if you're a small business owner or you're on the healthcare.gov marketplace plans, those plans have what's called a premium tax credit. So those are, again, at certain income thresholds based on your adjusted gross income. So if your income is low enough, then you basically either get a subsidy or a credit, so to speak, for the premium tax credit on your health insurance. And if you're a small business owner, you might be familiar with the QBI, or the qualified business income, and that is another credit that you might qualify for based on your income. So you want to take a look at your income because it will hit at all different thresholds depending on what credits you might qualify for in order to reduce your adjusted gross income, which is something that only the traditional side of your retirement plans can do by reducing it, putting it in pre-tax. So it's really important. Probably one of the most overlooked things are the credits that you might be qualified for if you just put a little bit more money into the traditional side of your retirement plans. So while the contribution limits haven't changed from 2020 to 2021 for the plans that I just went through, a lot of the income thresholds for those credits have changed. So you want to take a closer look at what you might qualify qualify for when you're trying to decide whether or not you should put it into the traditional or the Roth side of your retirement plan. And that is the 2021 contribution limits. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.